couple of days ago, Sven Henrich tweeted this out. What do you buy now? Do you buy Austrian debt at 2%, beyond meat at 900 times forward earnings? Do you go into the FANG stocks and hope that everybody just doesn't sell them? Or heck, do you just trust the American Fed and buy the S&P 500? We sense a touch of tongue-in-cheek in that tweet. So let's find out what he meant and bring in Sven right now. He is the founder of NorthmanTrader. Sven, thank you very much for joining us. So with all that, and you're making a good point sort of with that touch of sense of humor there, but what is there out there that you think looks like a good value to buy right now?
Well, Brian, it is a tongue-in-cheek tweet, and it's really relating to the fact that there's no attractive investments in terms of the larger investable universe, and you either buy things that are extremely expensive and overvalued, or you're going into negative yielding debts or low yield instrument. It's a chase, and as you said in the outset of your program here, every day there's a headline that may turn markets lower, turn markets higher. It's a big chase for yield, and it's a dangerous environment from my perspective. So in terms of the buy, we actually have been going and looking at gold since May, and it's been an incredible run. 20% move, and it speaks actually to the volatility that is taking place in the underlying sectors. It's not only gold. Oil dropped 25% since from the April high, and of course yields have been collapsing. There's a lot of stress in the system that we saw a little bit of that spilling into equities last week. I mean, it was actually a fairly sizable move. We dropped 8% on the ES futures in a matter of days, and it shows how little support there is when these things happen. Because as you may recall, June, July, we had this like low volume, steady rally, uninterrupted into the key technical zone of 3,000, 3,050, and then now we've dropped from there. So a volatile environment.
Yeah, and you talk about a headline-driven market. I mean, a few moments ago, Hong Kong protesters storming the airport. China obviously had no choice but to close that airport. The minute that headline came out, stock futures dropped about 50 to 75 points in the blink of an eye. Is that the kind of environment that we are in right now?
Absolutely. I mean, it can even be a tweet, right? We saw that in July from or early August from President Trump, right? On the trade war, it happens every single day. We saw it a little bit on Friday. You can certainly get a headline, all of a sudden you rally 20 handles, or you can drop 20 or 30 handles. So it's a very difficult environment for traders because you're either on the right side or the wrong side of a particular news flash. At the same time, my larger concern, Brian, is that if you take out all the noise, we're actually following a very clean technical structure. In July, we talked about a broadening wedge pattern into 3,000, 3,050. We hit that precisely in terms of S&P 3028, and since dropped, then had this big drop here in early August, and we see the VIX exploding, right? It came out of a consolidation pattern that we've seen repetitively over the last few years, and so there is a rising trend in volatility. And from my perspective, all this points to a larger wall that we're all hitting, and that is valuation on these markets. In fact, you can talk about it in context of bubbles, and there's a way to define bubbles, and I can walk you through that. It's pretty fascinating from a market cap to GDP perspective.
Yeah, and we don't want to send up too much of a warning flare, but you have noted that if you go back to the late 90s and right before the financial crisis, again, sort of very serious date comparisons, when we hit that, the U.S. stock market is about 140 to 150% of U.S. GDP. Bad things have happened.
Yeah, look, I mean, if you go back to the 80s and 90s, if you look at the overall market value of the stock market vis-a-vis the GDP, and that's kind of the classic bubble definition, if markets or valuations disconnect too far from the underlying size of the economy, you run into trouble. You know, we were in 40% to 60, 80% in the 80s and 90s. And then the tech bubble happened, and we got to 146%. And that's when we had that reversion, the crash, and kind of a right sizing, if you will. And then we did it again. We did it in 2007 with the housing bubble, and it peaked roughly around 137%. So again, a far extension above the GDP ratio. And now in this last 10 years, with all this cheap money, low yields, and debt expansion, we actually have done it again. And ironically, the big peaks we saw, and every time markets got into trouble in the last year and a half, was when we exceeded that ratio again. It was 147% in January 2018, it was 142% in September, and just now in July we hit 146% again. So this seems to be a valuation wall that there's really no history to suggest we can maintain it or even exceed it. So this is uncharted territory here.
And a little bit of worrying signs for the U.S. stock market to you, Sven.
Absolutely. I mean, you know, we are not only at these high valuations, we are at 50-year lows of unemployment at 3.6, 3.7%. There's no history to suggest we can extend both. So something has to give here. I mean, we need that growth spurt, and we don't see it anywhere. As you just pointed out with the Goldman Sachs provision, growth is slowing.